Good evening, everyone.
Good evening.
One second. Okay. So today's class, or today's webinar rather, is going to be IFRS versus US GAAP. Okay, as you all know, right? And for a brief introduction of myself, okay, so one second, guys. Yeah, so just to introduce myself, my name is Musal Kazim. I have worked in various capacities over my 25 years of career in accounting and finance. Okay. And I'm a full-time faculty of Hawk International and a guest faculty for Uplift for the CPA program. And today I'll be talking about IFRS versus US GAAP, the difference between it. Okay. Now, first of all, are you happy to be looking at this lecture? Right? If you are happy, then something is wrong. The reason being, we shouldn't be having a difference in the first place. Okay. They should be, ideally, there should be one global standard. Don't you guys agree with me? Right? There should be one global standard and the whole world should be following that or trying to follow that at least. Okay. Having a difference between IFRS and US GAAP causes unnecessary additional administrative and accounting work. Right? So what I would request everybody to kindly mute your mics. Okay. And you all can use the chat box to chat with me. So as I was telling you in the beginning itself, we shouldn't be having this webinar because we shouldn't be having two standards. Okay. But unfortunately, we have an international financial reporting standards and a US generally accepted accounting principles. Okay. We are having these two standards instead of having a single global standards, right? Ideally, that should have been the case. But why is it not like that? Why do we have these standards in the first place? Why are we having two standards in the first place? First of all, these standards are mainly for public limited companies. Okay, so public limited companies whose shares are listed in the stock exchange. Okay, so since the public has invested, we need to have a uniform standard, right? So that the public across the world is able to read and understand those financial statements. Okay, so that is why US GAAP has got over 100 accounting standards, okay, much more than IFRS, because US GAAP is also industry specific. Some of the standards are specifically for certain industries like oil and gas industries. Okay. And yes, the SEC, the governing body of the US Stock Exchange, the Securities Exchange Commission of the US, would insist that any company being listed on US stock exchanges should follow US GAAP, right? US GAAP compared to the IFRS. Now, if you know IFRS, it is applicable to all countries, not a specific country. Okay, even though even though some countries like China may not be following it. Okay, because in most countries, the law of the land would take precedence over the standards, right? Because there is standards. Now, standards has to be followed, but if there's a law there advising or instructing all companies to follow a particular format of the balance sheet and the income statement and all the other financial statements, those countries are obliged to follow the law rather than the standard. Okay, so in many countries that is the case. Okay, but as far as possible, the principles of IFRS are followed by other countries other than US companies globally. Okay, now there has been or there is an ongoing effort to converge these two standards. Okay, US GAAP and IFRS, and make it the same, right? They are trying to converge it and make it the same, but they are facing a lot of challenges. Okay, right? Because some of the differences are so wide that causing them to have one standard or to follow IFRS rather, okay, would cause a lot of misrepresentation of facts. Okay, right? Just to change suddenly like that, from the US GAAP to IFRS, it would cause maybe sometimes, overstating the income. Okay, so they will do it. Probably our grandchildren would see one global accounting standard. Okay, but for the moment, unfortunately, you guys have to be bilingual. You have to know IFRS and US GAAP, because many companies' financial statements has to be converted to US GAAP, okay, from IFRS to US GAAP and vice versa. Okay, there would be some requirements, because sometimes if the company wants to be quoted in the US stock exchange, okay, or they are a subsidiary of a US parent, they have to make their statements, financial statements following US GAAP. Okay, unnecessary double work, which costs a lot of money. Okay, just look at it globally. Don't you think, guys, this is very unproductive work, right? Because what are they doing here? Okay, in the meanwhile, a lot of professionals are getting paid very well because then they are bilingual, etc. But this is like, I feel it is like money down the drain. Okay, nothing productive is happening here, right? Right, because we are having two standards. But yes, what can't be cured has to be endured. Okay, so we have to study this. Now, what are we going to do in this class? Of course, there might be many differences between US GAAP and IFRS. Okay, and in many areas of accounting, many topics like cash flow, inventory, property, plant and equipment, intangibles, etc., etc. Okay, but I will be dealing with a few of these areas and will be talking about the main differences. You understand me? Right? Because no point talking about very small differences which doesn't very much matter. Okay, but the major differences and in the major areas due to our time limitation. Okay, so let us start talking about the first of such differences, which I am starting with. Okay, that is in the cash flow statements. Cash flow statements. Now, all of you know that the cash flow statements, either direct method or the indirect method, would be classified into operating, right, investing, and financing. Operating, investing, and financing. Then you have the net cash flow. Okay, then you add to it the opening balance and arrive at the closing balance, which would be taken which would be taken into the balance sheet. Okay, actually, I'm sharing the screen. Can everybody see my screen? Can everybody see my screen? Just say a yes or no.
Yes, sir.
Yes, sir.
Yes, you can see it. Okay, okay.
Yes.
Right. Thanks.
Yes.
Okay, because one person cannot see, so I think it's something to do with his Atul. I think it's something to do with your computer. Everybody else can see. Okay. Right.
Maybe I'll connect it with my laptop, sir.
Okay, do that.
Thank you.
Okay, right. So operating, investing, and financing. Now, there are certain items under US GAAP is classified in a certain way, and in IFRS classified differently. Now, let us just see what are those certain items. Now, for example, money collected from customers. Okay, money collected from customers. Where will it be classified? Operating, investing, or financing? Under both US GAAP and IFRS, money from customers is going to be operating. There's no doubt about that. Okay. Now, salaries to staff would be operating. Okay. Taxes would be operating. Okay. And what else? Under both IFRS and US GAAP. Okay. Payment to suppliers, operating. Okay. Now, where is the difference basically? Now, let us talk about issue of share capital. Issue of share capital, where will it be classified as?
Under IFRS, sir?
Financing.
Finance.
Under IFRS or US
Investing.
GAAP?
Financing.
Investing.
Yes. Financing. Yeah, you can please chat because there are a lot of people. Generally, I would tell people to speak up when there is a few people, but here I think we have how many? I don't know. Okay, more than 40. Okay, so definitely, if everybody speaks, it will be a problem. Okay, so just as much as possible, chat there. Yes, financing. You're right. Issue of share capital is going to be here. There is no doubt about it. And IFRS as well as US GAAP, there's no difference there. Okay. Now, you took a loan from the bank. Where will that be classified? Yes, it's going to be under financing. Okay, loan from outsiders. Okay, creditors rather. Okay, so it is going to be a financing issue. Now, okay, so dividends paid to shareholders. Okay, where will it be classified?
Investing, sir?
Financing.
Investing?
No, dividend paid to your own shareholders, okay, would be financing. Okay, just ignore this. Okay, so I'll put here dividends paid to own shareholders. Okay, the company's own shareholders. Okay, now I saw one comment there saying that if it is more than 1 year, the loan is lasting for more than 1 year, it is financing. That is a wrong concept, please. Okay, loan lasting for more than 1 year or less than 1 year would be financing only. Okay, because they're financing the company. Fine, right. So dividend paid definitely is going to be financing. Okay, because if you look at it logically, it is a result of the share capital. Is it not? It's sort of a cost of the share capital. Am I right? It's a sort of a cost issue to cost of issuing the share capital. Now, from the loans, what do you have to pay? The loan also costs money, right? What do you have to pay where loan is concerned? Yes,
Interest.
Interest comes here. Interest would be paid for a loan. But where would you classify
Financing.
interest? Where would you classify interest? Yeah?
Financing.
Financing, yes, in IFRS. Okay. Now, the strange part is in US GAAP, interest paid
It's operating.
is operating. Is operating. Okay. In US GAAP, this is US GAAP. Now in IFRS, you have a choice. Okay. You can either put it in operating or financing. There is an or there, but in the US GAAP, there is no or. Okay. So interest paid is now in IFRS can be here or here. You got it? But you see, if you ask me logically, it makes sense to put it in financing, is it not? Right? See, the cost of share capital is dividend. So we put it in financing. The cost of taking finance from the bank, okay, the cost of taking finance from the bank is interest. And ideally, it should be put in financing. But US GAAP puts it in operating. Okay, what I have found, what I feel why they are doing this, okay, it's a man-made subject. Okay, it's a man-made subject. So what I feel is happening here is, look at it this way. Now, everything which is debited or credited to the income statement. Okay. Now, when you're starting your cash flow, you're starting from net income, is it not, under the indirect method? So the income statement debits and credits would be included here in the net income. Okay. So they let it be there in US GAAP. They are not going to move it around, interest paid from here and then take it back to the financing area. They're not going to do that. Okay. They're going to leave it as it is. Now, interest paid is debited to the income statement. Am I right? It's a charge against profit. Interest expense would be there. So they let it be there and it's part of operating cash flows. Okay. Now, similarly, you invested in other companies' shares. Where would that be classified? Under both US GAAP and IFRS. Now, for example, HP has invested in Apple shares. Where would that be coming? Under operating, investing, and or financing? Yes, it would be. It would be coming under
Investing activities.
Investing activity. Yes, no doubt about that. Right. Now, what do you get from that? Please kindly mute your mic. Please mute your mic. Okay, thank you. Okay. So it's coming in investing activities, but what is the fruits of that? You are going to get dividend, is it not? You are going to get dividend, right? Okay. So where would you classify that dividend? Where
It will go to operating activities.
Under US GAAP, operating activities. Okay. Dividend
Right.
will go to operating activities under US GAAP. Why? Because if you notice the accounting entry would be debit cash, credit, dividend, income, is it not? It would be included in the income statement and therefore in the net income when you start under the indirect method. Okay, so you're not going to move it around in US GAAP. Dividend received would be operating under US GAAP. But IFRS, you have a choice. You can put it under investing or operating, but you should be consistent. It's not that 1 year you put it in operating, next year you change it to investing, and that will be causing confusion in comparison while comparing, because they would at least present 2 years cash flows or any financial statements. They would present at least 2 years for comparison, is it not? Comparison is a must, right? Right. So that time it would distort things. So be consistent. Since IFRS, you have got a choice of either investing or operating. Decide where you want to put it. But US GAAP, there's no choice. It's nice that way when there's no choice, is it not? Right. Right. Supposing you're going on a road and there are 2 roads. The road is splitting into 2. You have a confusion. But if it doesn't split at all, you have no confusion. You just follow the path. Okay. So that way, dividends received would be always under operating, under US GAAP. Now, the company the company issued bonds. I mean, the company invested in bonds. No, don't get confused here. It has invested in bonds of other entities. Okay, for example, a Reliance company buying L&T bonds. Okay, so I already put it there under investing. I'm not asking you the question. Okay, so bonds have been invested in. Okay, the fruits of that would be interest. Now, interest received, this is not interest paid. Okay, this is interest received. Where will you put it? Where will you put it? Interest received.
Operating.
Operating activities.
In US GAAP. Okay, operating in US GAAP. Interest, pardon my spellings. Okay, interest received. Fine, that would be operating in US GAAP. Again, what is the entry? Debit cash or interest receivable and credit interest income. Is it not? And where does this
Right.
go? It goes to the income statement, and US GAAP doesn't believe in moving it around. It remains there. Okay, so it's all a part of operating activities. Fine. In IFRS, you can put it under investing or operating. The choice is
Or
yours.
operating.
Yes. Okay, the choice is yours. But I think most of them follow put it in investing only because it's logical, is it not? Don't you think it's more logical? Because you have invested in something, you're getting something from it. So it should be an investing cash flow, right? But US GAAP takes it as operating because even in their income statement, it would all come under income from continuing operations. Okay, so this would be the case. Okay, but wherever you're putting it, be consistent. Okay, now coming back to dividends paid to own shareholders. Why is this exception? Why is it put in financing and not operating? By the way, in IFRS, you can put it in financing, dividends paid to shareholders, you can put it in financing or operating, by the way. But I think very rarely people put it in operating. Okay.
It is a financing in nature. It is a financing in nature because of it is coming from the shareholders fund.
Shareholders fund, yes, but loans also comes from creditors, is it not? Okay,
Yeah.
so but the interest interest is going to operating interest paid in US GAAP. Okay, so what is this? What is the logic? As I told you, what US GAAP must be seeing is everything credited or debited to the income statement should remain there in operating. Okay, now dividend paid, let me just elaborate. In IFRS, you have a choice, operating or financing, but I think most of the population would put it under financing, even in IFRS. Okay, but in US GAAP, let us look at the logic. Why are we putting it there? Because it's not now going to come. It's not a charge against the profit. It doesn't come in the income statement. Do you agree with me? Dividends paid to shareholders, does it come in the income statement as an expense, dividend expense, something like that? It doesn't come, right? What's the entry? At the time of declaration, you would debit retained earnings. Okay, this is a US terminology again, anyways. Okay, debit retained earnings. Okay, and where will you credit? You'll create a liability, dividends payable. So if you notice, at the time of declaration, this is not going to the income statement, the debit. Okay, it's going to the equity side. Debit, it's paid. It's an appropriation of profits paid out of after-tax profits. Okay, debit retained earnings, credit dividend payable. And the time of payment, it would be debit dividends payable and credit cash. Okay, so it's not coming in the income statement at all. Okay, so that's the reason we are classifying it under financing. Okay, right. So in many exams of US GAAP, especially if you're taking up a US GAAP examination like the CMA or the CPA, this would be tested. They would always test your knowledge in where you're going to classify, especially interest paid. Especially interest paid. They are very, very interested in how you would classify that part. Okay, that is tested very often. Okay, so these are some of the differences in the cash flow statement. Okay, these are some of the differences in the cash flow statement, right? And now let us move a little further and go to something called the comprehensive income statement. I'm putting a lot of shortened forms because if you are not concentrating, you may not get it. Okay, so I put here comprehensive income statement. What does this mean? Comprehensive, what is the dictionary meaning of the word comprehensive? Comprehensive is entire, including everything, right? You're going to include your net income. Yeah, like you have comprehensive insurance, it covers everything, right? So you're going to include your net income in this statement, come from the income statement. And along with that, there are 4 other items. This is, I'm talking about US GAAP. Okay, there are 4 other items which would actually not come in the income statement. Certain unrealized stuff is not going to come in the income statement. Okay, so what are those? What are those? Unrealized, again, I'm putting shortened forms. Okay, gains or losses from available for sale securities, AFS, available for sale securities. Now, what do you mean by available for sale securities? Available for sale securities are bonds, not shares. Previously, even shares used to be classified under available for sale. Now, no. Okay, it's your investment, but it is bonds which are going to be classified, which you are not going to sell in the near future. Neither are you going to hold it until maturity. Okay, the intention of the company is to keep it maybe for a couple of years, okay, and sell it off. But in the meanwhile, it goes up and down in price, is it not? Before they sell it. Remember, bonds also have a secondary market. Many people have the misconception that bonds, once you buy it, you hold it until maturity. Okay, it's wrong. Bonds, especially the US bond market, is very, very active. Okay, don't want to hold it, sell it in the bond market, just like you sell a share. Okay, even in India, you can do that. Okay, so bonds are going up and down in price depending on the interest rates, etc. Okay, so you can sell it, and any going up or down there, any change in prices, change in fair values is put in other comprehensive income. Okay, now just for clarification, net income and these 4 items are called other comprehensive income. Okay, so OCI, sometimes given a shortened form, OCI. Generally, we follow the historic convention of accounting, is it not? But there is a departure here for investments. Investments, we mark it up to market. Okay, unrealized gains or losses comes here. Then unrealized gains or losses from a cash flow hedge. Now, hedges, etc., would take a long time for me to explain. Just for now, know that it is an investment which would reduce the loss of another investment. Okay, so unrealized gains or losses from a cash flow hedge, especially in the futures market. Okay, so that would also be put here. If you realize, so far everything is unrealized. Okay, and unrealized gains or losses from pension fund investments. Now, many companies have got a defined benefit plan, is it not? Pension funds. What do? They take your money, they put in their money also and invest in funds so that you can have a retirement pension or a retirement fund. Okay, so what happens here is they would not keep these funds idle. They would invest it in shares or bonds or whatever. Okay. And those things go up and down in price, right? The unrealized part, if they have sold it, it comes to the income statement. Okay. If they have not sold it and the holding gains are going up and down, they would put it here. Okay. And then finally, cumulative foreign exchange translation. Okay. Now, what is this? When a parent, let us say US parent, invest in so many subsidiaries across the world, okay, in Saudi Arabia, in India, in Kuwait, in many other countries, okay, when these subsidiaries have to be consolidated because they are owned by the parent, when they are consolidated and reported in one currency, which is the US dollar, there's bound to be some exchange differences. Okay. In the CMA and the CPA course, you study how the process takes place. Now here I will not be explaining that. I'm just giving you the gist of it. So this exchange difference would be put here because that's also unrealized. They are not going to sell the subsidiaries right now. Okay. So those exchange gains or losses would be put here. Okay. So just to give you a brief, these are the what do you call other comprehensive income items. Okay. And this would give you the total of other comprehensive income, which only these four. Then the net income plus you add this also, net income plus the other comprehensive income is equal to comprehensive income. You understand? Net income plus the total of the other comprehensive income would be your comprehensive income. Now, a point to be noted. Suppose you don't have, your company doesn't have all these four. Okay. If it doesn't have all these four, what is your comprehensive income? You can easily not have available for sale securities. You have not hedged your transactions. You don't have a pension fund. And you don't have, you don't have subsidiaries. Okay. You're not consolidating any subsidiaries. So what would be your other comprehensive income? Yes, this would be zero.
So the net income becomes a comprehensive income.
Yes, the net income becomes a comprehensive income. That's it. Okay. Now, how is this changing in IFRS? Let me just give you, I'll share that with you. Okay. So going back in IFRS, one second. Yeah, there was a blog here from KPMG, I think. Oh, no, PwC. Okay, you have the same thing in IFRS. You have, if you notice, the OCI part is there in IFRS also. Okay, foreign currency translation was there. Okay, and there is a slight change in available for sale security terminology, etc. We'll come to that later. But change in fair value of available for sale financial assets, yes, put it there. Accrual gains and losses arriving from pension funds, it's coming there. And change in fair value of a cash flow hedge, which is a derivative, it's coming there. So what is not coming in US GAAP is this one, is it not? Revaluation of property, plant, and equipment. Okay, so that is, you see one thing, IFRS may not call it comprehensive income as such. They would create reserves. IFRS is very fond of calling these things reserves. A revaluation reserve is nothing but going to the equity. Okay, maybe not called specifically other comprehensive income, but it will be called a reserve. Okay, so all these things would go into reserves in IFRS. US GAAP doesn't like the term reserve. I don't know why. Okay, they don't use the word reserve at all. Okay, they would use something like allowance, but they won't use the word reserve. Okay, But IFRS, you have got, statutory reserve, general reserve, revaluation reserve. So these things might creep into some reserves. Okay, right? But this is the main difference. Why is there a difference? Revaluation of property, plant, and equipment. Because here, when I'm at it, let me tell you a difference again between US GAAP and IFRS. In IFRS, you can bump up your assets. You can revalue your assets. You can increase the value of your assets to reflect fair values. Okay? In US GAAP, you are not supposed to do that. You understand? You're not supposed to do that. Why? They are super conservative. Okay, if you purchased a land way back in 2005 and it cost you 100,000 US dollars, historic cost. And today you're 2021, you're making your balance sheet in December 31st. You would put the same 100,000. Okay. Right? You'd put the same 100,000. You can impair it. You can bring it down in value under US GAAP. Okay, but you cannot bring it up. You cannot bump it up. In IFRS, it's permitted. Okay, and any difference that increase in value is put not in the income statement, in the revaluation reserve, which is a part of comprehensive income. Okay, got it? One small difference. That's the small difference again in the comprehensive income part. Please note. Okay, right. Comprehensive income, and also I told you related to PP&E also. PP&E, the difference between US GAAP and IFRS is revaluation not permitted in US GAAP. In IFRS, it is. Okay. So now, let us move on to other differences. The other major difference would be in the area of inventory. Okay. Inventory has got a lot of it. So let me go to that. Okay, 1 second. Yeah. Let me go to the area of inventory. And let me talk about inventory and IFRS. Okay. And let me talk about the main differences. Main, okay. There are several others, but I'm talking about the main differences. Okay. These are the main differences. First of all, let me bring to your notice one very prominent difference, which is very important. Okay. LiFO permitted, last in first out permitted. See, I'm not going to explain exactly what is LiFO, etc. Okay, because I take it for granted that accounting professionals are attending this course. So I will not go to the basics and tell them what is LiFO. Okay, so you should be understanding last in first out inventory flow assumption. That is permitted under US GAAP. Under IFRS, it is prohibited. This is one major difference. I'll come to the others later. For example, this, I wouldn't call it a major difference. Okay, I'll explain that later, but I wouldn't call it a major difference. But this is one of the major differences. Okay. So now, in an inflationary economy, exactly, what does it happen? What does happen? So you're buying one item maybe in January, okay, at $10. The same item, maybe you buy it in March, it's slightly going up in price because most of the economies are inflationary, including the US. Okay, so you have got August, maybe it is gone up to $13, whatever. Okay, so when you are going to sell it. Let us say the sale is going to be for $20. Okay, or $15. Let us say you're selling it for $15. Under LiFO, what would be your cost of goods sold? The last one in is going out first. Okay, COGS. So $13. Okay, and you have got a profit of $2. Okay, but compare that with FIFO. Suppose if it was FIFO, like you would follow under IFRS, what would happen is the first one in would go out first. First in, first out. Okay, that would be COGS. You'll have 10 and you'll have a 5 profit. Okay, so what do we learn from this? LiFO is going to show, generally, it's going to show a lesser income. Okay, probably that is why it's allowed in US GAAP, because it is super conservative, as I told you, right? It's much more conservative than IFRS in many aspects. Okay, in many aspects. Sometimes IFRS is more conservative, but most of the time it's US GAAP. Okay, and not only that. Okay, yeah, I'll come to the inventory valuation later a little bit, Praveen. Okay, right. So first here, yes, not only reducing the income. Why do they want to show less income? In order to pay less taxes. You understand? So they would pay less taxes because they're showing lesser income. About 30% of the US companies follow the LiFO in order to bring down their tax bill. Okay, there is a LiFO confirmatory law which says that if they are showing it LiFO for tax purposes, they have to also show LiFO for financial purposes. They cannot show FIFO for financial purposes and LiFO for tax purposes, for example. Okay, they cannot be two-faced, right? They cannot show a shareholders a very rosy picture and tax people a bad picture just in order to pay lesser taxes. So they have to follow both in the financial books as well as in the tax books. They have to follow LiFO if they are adopting LiFO. IFRS does not permit that, probably because the tax authorities has a hand in it and they want companies to pay more taxes. Okay, so in IFRS, you have got specific identification method, you have got FIFO, and you have got weighted average. In US GAAP, you would have actually specific identification. Okay, I'm just putting all shortened forms, but I'm telling the full thing. Specific identification, the retail method, okay, which we rarely do it anyways, but retail method and FIFO, weighted average, and LiFO. Okay, and LiFO. Got it, guys? So that is what you would be doing. Okay, so now the next major difference is this one. The inventory valuation at year end, after you have followed LiFO or FIFO or whatever it is, you are going to value the inventory again. Okay, now historical cost holds good for everything except inventory and except investments. Okay, in inventory we are going to be more conservative. In investments we would record even the what you call gains as well. Okay, but in inventory what happens is they are going to be more conservative, both IFRS and US GAAP. Okay, so how is this? What is this? What does this mean? LCNRV or LCM? What does it mean exactly? Lower of cost, just note down, I'm not writing it. Lower of cost or net realizable value. Okay, and here it is lower of cost or market. Lower of cost or net realizable value or lower of cost or market. In IFRS, it's going to be only lower of cost or net realizable value. Okay, now what am I talking? See, unless you know something about this, what I just now said doesn't make much sense. Am I right? Right? I can just, for namesake, tell that in US GAAP, there is LCNRV or LCM, and IFRS, there's LCNRV only, and proceed further. Okay, right. But I know some people want a clearer picture on this. Am I right, guys? Or do you know already what is LCNRV and what is LCM? See, basically, US GAAP is very fond of rules. Okay, a lot of rules. Okay, so to demonstrate that, let me just go to a question. Okay, just a question, just to understand, for you to understand better what is this all about. Okay, I'll explain it to you with the help of a question. Just a minute. Okay. Everybody can see this question bank, right? Okay. Now, under US GAAP, please take some time and read it. Please take some time and read it. All seems quite strange, no? Okay. So if you have read it, now please note something. If a company is following LiFO, okay, if a company, US company only can follow, whoever is following US GAAP can follow LiFO, is it not? Right. We are talking about US GAAP now, basically. Okay. So if they are following LiFO or the retail method, so we are not going to do the retail method. We'll talk about LiFO in the first place. Okay. If they are following FIFO, etc., it's a different different rule. Okay. Sorry. If they are following LiFO, they have to follow something called the lower of cost or market. Okay. If they are following FIFO, weighted average, etc., or specific identification, they have to follow lower of cost or net realizable value. I'm talking here only about US GAAP. Okay. Now, what is this lower of cost or market? And what is this ceiling and floor? Okay. Now, here there are two things. There is the historical cost. We're talking about cameras here only. Okay. We'll talk about cameras. Okay. There is historical cost. There is replacement cost. Okay, replacement cost is considered to be the market. Okay, it's considered to be the market. Now, what is the historical cost for cameras? Can you tell me?
210.
210.
It is the purchase cost. It is the original purchase cost.
Correct. The original purchase cost, 210. Okay. And what is the replacement cost? 203. Okay. Now, generally, we would put it at 203. Okay. And forget about the whole thing. But no, there is a certain rules which we have to follow. We have to make an upper limit called the ceiling and the lower limit called the floor to limit the change in market rates. Okay, right. So we are not going to put it anything above the ceiling. We are not going to consider anything lower than the floor. We are not going to consider. Let us just show it with an example. Then you will understand. Okay. Right. Now, the ceiling is the net realizable value. Now, net realizable value is the selling price. Okay. Selling price and the cost to sell. The cost to sell is this much. minus that. Okay, so that would be the net realizable value. How much is that? Can anybody tell me how much is that?
198.
198. Okay. And the floor is 198, the net realizable value, minus the normal profit margin, which they make from it. How much is that? 198 minus 32. The normal profit margin, which is 66, 166. Okay, right. So this is how we are doing it in US GAAP. We are establishing the maximum limit, okay, and the what do you call minimum limit. Okay, so for this the answer is D. Okay, but we are not going to stop at that. We will do the full valuation. Okay, here they just asked you the ceiling and the floor. Now you will take the replacement cost, which is generally the market, actually, to replace it. We will see whether the replacement cost is above the ceiling. Is it greater than the ceiling? It is greater than the ceiling, is it not? It's coming at 203. Is it lower than the floor? It is not lower than the floor. It is greater than the ceiling. In which case, actually, the ceiling becomes the market. Okay, we are going to limit this. Okay, because it's going above that. Okay, the maximum which it can go is above. I mean, it shouldn't go further than this. Okay, if 203 is above the ceiling, we make ceiling as the market. And we'll compare it with the cost, 210. Okay, and we will take lower of cost of market, which in this case is nothing but 198. We have to compare the lower of this. See, so much of rules in US GAAP. Okay, which we compare in the, and it becomes this one is the lower thing. So LCM, lower of cost of market, is 198, and we'll recognize a write down. Okay, what it will be? It will be like this: debit loss due to LCM. This would go to your income statement. Okay, how much is that? 12. And credit and LCM allowance, 12. Okay, this would go to the balance sheet. So in the inventory, in the balance sheet, you would show camera like this, 210. The allowance for LCM, you would show 12. Okay, as a contra asset. Okay, you will show 12. And 198, you would show the carrying value, which is the written down value. Okay, so these are the rules. Now, here, let me tell you something. Had the replacement cost had been, let us say, 180. Okay, instead of this, had it been 180. Okay, then 180 is not greater than 198. And it's not lower than 166. It is coming in the corridor. Okay, in between 198 and 166. Then the market would have been the replacement cost. You understood? Then cost would have been 210. The market is considered to be the replacement cost because it is falling in the corridor. Okay, and LCM would have been 180. So you'll write it down by 30. Okay, right. Now, another scenario. Suppose the replacement cost was 150. 150. Okay, then you'll compare it. Is 150, you are going to compare always the replacement cost. Is 150 greater than 198? It is not. Is it less than 166? It is. 150 is less than 166. Then the floor becomes the market. That is the limit. Okay, you will not write it down to 150 here. Okay, the floor becomes the market. So the market now would be cost 210, market, the floor, not the replacement cost. Okay, the floor. You are not going to go below that 166. And LCM, lower of cost or market, is going to be 166. Okay, got it. So these are the limits. US GAAP makes it more complicated. Okay, so this you will follow. This you will follow only if you have been following the LiFO or the retail method. Okay, if you are going to be if you are following the weighted average and the FIFO method, then it is going to be lower of cost or net realizable value. Let us do that also. Okay, let us do that. What is lower of cost? Instead of this floor and ceiling, etc., for lower of cost or net realizable value, all that doesn't come at all. Okay, now suppose if it was, you have been following the FIFO or weighted average or any other method under US GAAP. Okay, and if you are following the IFRS, it's going to be LCNRV. IFRS only LCNRV. There is no LCM. No that headache of floor and ceiling. Okay, now let us talk about the camera itself. We are following FIFO or weighted average. We are going to do LCNRV. How do we do that? First, you take the cost. Okay, take the cost, which is 210. And then take the net realizable value, which is equal to 217 minus 19. Anything to distribute or to process further. 198. See which is lower. LCNRV. Okay. LCNRV, sorry. LCNRV, lower of cost or market, is 198. Okay, so you'll write it down by 12. Simple. No need of ceiling, no need of floor. Okay, and no need of talking about the replacement cost also. They are not even talking about the replacement cost. So, suppose under IFRS, you want to value the tripods. Can you value the tripods for me? Under IFRS. Under IFRS. Try to value the tripods and tell me how much it will be.
It's 53.
What?
53.
53. He's right. We'll take the cost first, which is 53. Then we will take the net realizable value, which is equal to, please mute your mic, minus 2.5. Okay. 17.75 minus 2.5 is equal to
18.25.
71.25. Which is lower? The cost is lower. LCNRV. Lower of cost or market? Okay, lower of cost or LCNRV. I mean NRV. That's what you have to see. Okay. So in this case, the cost is lower. We don't have to make any accounting entry at all. Okay, we don't have to make any accounting entry at all. Got it? It's the US GAAP sometimes which causes all these problems of the floor and the ceiling, but it is there for a purpose. Okay, it's there for the purpose. Okay, now can anybody tell me why are we insisting on writing down the inventory? Why are we insisting on writing down the inventory? Why can't we just leave it as it is? Okay, both in IFRS and US GAAP, you are going to make an adjustment, is it not? You don't want to carry the inventory at higher levels. Why? You see, I'll tell you. For example, in camera.
Gains.
In
Gains
camera,
or
what
losses
happened?
can be
Pardon?
accounted in the same. Gains and losses can be accounted in the same period.
Correct. No, gains. There's no question of gains. Let me tell you. In US
Let's suppose
GAAP,
if inventory is
Yeah.
adjusted, the
Yeah.
loss, if there is
only
any
loss,
from the
only loss. They will not allow you to put any gains in their books.
okay, loss.
Okay. So you have got a cost here, 210. Okay, you're carrying it at this. Now, if the NRV, in this case, there was also, what we did, LCM we did also, right? So if the NRV is now 198, okay, that means ultimately when they sell it, they're going to get only this much. Okay, they're going to get only this much. Fine. If they're going to carry the inventory at this much in the next period, they're going to make a loss, is it not? Assuming that you'll sell it in the next period. Your selling price minus the cost to sell would be 198. And you are carrying the inventory at 210. You will make a loss of 12 in the next period when you sell it. They don't want you to recognize the loss when you sell it. Why postpone the loss for a previous period? Show the loss right now. You understood? That is their logic. Show it in this period itself. Don't show it in next period because you really don't know when you will sell it. Maybe you will not sell it in this next period also. You may sell it after 2 years. So are you going to delay the loss by that much? Okay. So what if the company liquidates right now? You know, those kind of things. So show at the value which is lowest. Conservatism. Okay. Don't overvalue your assets and don't postpone recording a loss. That is the logic for both IFRS and US GAAP, but US GAAP is more aggressive towards it. Okay. They want to show the loss wherever possible.
Hello?
Yes.
No, then is it like making a mark to market?
No, mark to market is they will also show gains. Now for investments, it is mark to market. You
Yeah.
understand?
Yeah.
Right. Because the reason is for investments, you're kept it to sell it, is it not?
Yeah.
Okay.
Yeah.
So, but inventory, no mark to market.
But it amounts to that.
Lower of cost of market.
Agree,
Lower
but it
of
amounts
cost
to
of
that.
market.
But you're trying to be conservative means it almost amounts to that. The market
Not
is
exactly.
less.
I'm telling you something. If it goes up more than the historical cost, you're not going to recognize it. You understand?
Okay. Yeah. Okay.
So that way it's not mark to market, is it not?
Okay.
Only the bad side of mark to market. Okay.
Excellent.
Not the good side. Okay.
Yeah. Right.
So that's what they're going to show.
Okay.
Fine.
Right.
But investments you will do. Even the good
Yeah,
side you will
right.
show. It's going
That's
up in the price. Even US GAAP would show. it.
Like in the case of bonds and all that.
Yes. They
Yeah.
would show it. Okay.
Yeah.
They would show it, but maybe in the other comprehensive income.
Yeah.
Okay. But for shares, they show it in the income itself. Okay. Income statement. We'll come to that
Sir,
later. So
one question. What if in the case of cost of sales is variable? Say suppose here $19 is fixed of selling in inventory, which they are adjusting in the same period. If it is a variable cost, so in that case, how they would adjust
they would
this cost of
estimate the best possible one, you know?
best possible?
Yeah.
Okay, sir.
Right. So that is about it. Right. So LCM and LCNRV. Now that's I just brought this question just to demonstrate what it is. So you may not have understood even 100%, but at least you have an idea what I'm talking about, right? When I say that in US GAAP, for if you're following FIFO, weighted average, or specific identification, you will follow the LCNRV rule, which is quite simple. If you're following LiFO or the retail, you don't know what is retail at the moment, and we don't have time to explain that. Okay. So if you're following the retail or LiFO, you will follow the LCM, and that LCM has all those funny rules: ceilings, floor, replacement cost. If replacement cost falls in the corridor, it is equal to the market. If it goes above, then ceiling is the market. If it goes below, then floor is the market. Then you will compare the cost and the market and arrive at the lower of cost of market. So much of rules. Okay, right. But in IFRS, only LC and RV. Because IFRS anyway is not going to follow LiFO. Okay, it's going to follow FIFO, weighted average, or specific identification. Okay, so only LC and RV. Now the funny part is another one. Once the inventory goes up in price, you cannot reverse it in US GAAP. Again, super conservative. Okay. Now the inventory which you wrote down, the camera, for example, it was 210. You wrote it down to 198. Is it not? Tomorrow the selling price or everything the net realizable value. Let us say the net realizable value in the next period goes up to 215. You are going to keep it at 198 only in US GAAP. No reversal of write down. Okay. But in IFRS, it's less conservative, is it not? It's less conservative. You can reverse it, but not to 215. You can reverse it up to 210. Does that make sense? Up to the original cost only. You cannot go further than that. Okay, you cannot go further than that. You got it? Let us test this concept for you. Okay, for that, instead of just talking, I'll give you a test, which is a CPA question. Now, your IFRS, you are going to apply what I just now told you. So if you are not concentrating, you had it. Okay. Okay. So just try to apply what I told you just now. Do this practice question. Put your answers in the chat box. Whether it's going to be A, B, or C, or D. Yes. We are having 31 people. Mehul says A, Sudhir says A. Anybody else? 31 people. I should have 32 answers. Okay. Praveen says A. Come on, guys. Yes, A is the right answer. A is the right answer. Okay. Because it's IFRS. Okay. It was 100. They brought it down to 80. They wrote it down to 80. Okay. Right. In year 1. In year 2, what happened? Now it has become 150. Now you cannot write it up to 150. You can write it up to original cost. So you debit inventory, increasing inventory, and credit expense. Okay, you can say inventory gain. Okay, or reversal of the write-off, but it's happening in the next year. Okay, right. So that you can credit it. Okay, so that is only because it's IFRS. If it was US GAAP, what would you have done? Can anybody tell me? If it was US GAAP, not IFRS, what entry would you have passed? You would have let it be at 80 only. You wouldn't have passed any entry at all. No entry whatsoever. Okay. That is how conservative US GAAP is. Okay. That is how conservative US GAAP is. Okay. Now, the others are, small differences. Okay. What they say is, what is that? Where is it? Okay. What they say is, one second. Not required to actually apply the
No.
same. Yes.
Sir, actually, the inflation accounting was initially started by USA.
Inflation accounting, is it?
Years ago.
Ah.
Inflation accounting was started by USA. But
Okay.
now, if you say the gap is more on the positive side, they won't take into account because
Yeah.
they're conservative. That is actually undoing what they had earlier done in the 80s.
You see, why they don't do it? Why do they follow the historical convention?
No, but they are fellows who started inflation accounting.
I know. Even then, even now, there are proponents of inflation accounting. Many people are saying yes. I think our grandchildren and all, when it comes to that, no, everybody would be doing current fair value accounting on, because historical cost does not give you the true value of the company.
Agreed. No, I agree. On the one hand, they are saying inflation accounting is the right norm. On the other side, you want to be conservative. They don't go together, no?
Correct. Now, because the conservatism wins because of evidence. You understood? See, suppose you bought a land for 100,000.
Hmm.
Okay. This is the historical cost. You bought it in 2005. Okay.
Yeah.
Now 2021, it has become now 300,000.
Hmm.
Okay. Now they actually, if you want to show the correct balance sheet, you have to revalue it to 300,000, is it not?
No, no, sir. 1 minute. See, here, land is not a business asset. What happens in the insurance chart accountants,
Hmm.
they say the business assets only need to be taken at market value if at all inflation accounting is to be
No,
followed.
no, I assume that this is a business asset.
Okay.
The factory is on that. Factory is on this land.
Plan.
Okay. Right. Now, what is happening is basically why they are not doing it. Now, you say it is 300,000. Says who? They would argue that the auditors want to know some evidence. You understood? So somewhere they'll say 300,000, somewhere they'll say 250,000. So until the deal happens, we really don't know what's the market price. Okay. So this one has got evidence. It has a sales deed, a sales document, which says 100,000. Auditors need something to tick, is it not?
No, but you can take a valuation certificate from an
No,
approved
no.
valuer.
See, valuation certificate also, it differs from
manage.
one valuer to another valuer.
I agree. I can manage it also.
Yeah. Right. So that is the reason. Okay. So let's tell it that's the reason they are still following. But I'll tell you, the future is, in my opinion, the future will be current cost accounting. Okay. Anyway, now the historical convention wins for the moment. Okay.
Yeah.
So these are not very, very important differences because what they're saying is, suppose you're following FIFO. Okay. And there are, let us say, different kind of what you call electrical appliances. Okay. Different kinds of electrical appliances like electric stove or something like that. For all the models, you have to follow. I mean, you don't have to follow the same FIFO for all. For some, you can do LiFO. For some, you can do weighted average. But IFRS says if there is the same kind of inventory, similar inventory, just different models, let us say bicycles, different models of bicycles, all should be following the same thing, FIFO or weighted average or whatever. Of course, no LiFO. Okay, but these are not such big things. And generally, in US GAAP, the physical flow does not have to match with the accounting assumption. Now, for example, you have got bags of rice here. Okay, pardon my drawing. Okay, these are all bags of rice kept like this. Okay, right. So basically, if you want to sell these, okay, if you want to sell this, you will pick up the one which is here itself. You know, it's homogeneous item. Everything is the same. You'll pick up one there and you'll sell it off to somebody. Okay, but you might be following the FIFO accounting. Okay, FIFO accounting means you are assuming that this one which came first is going out first. Okay, so there's a physical mismatch here. Okay, this might have come in last because you're putting all the last items here. Okay, so you are following, if you go to see physical movement is LiFO, but accounting movement is FIFO. Okay, but in IFRS, they want it to be as close to the account, the physical movement as possible.
But sir, in stock market trading, FIFO is the only thing allowed in under income tax.
Correct. Yeah,
Stock market
correct.
trading.
Correct. Because otherwise you will, yeah. Right. But here it is, in inventory, they want you to follow, in IFRS, they want you to follow as much as possible the physical flow. Okay. But in US GAAP, they're not bothered. So these are all small differences. You have to remember the main difference. If you ask me, the main difference is this.
I think weighted average will be the most ideal if one can do it.
Actually, frankly telling you, so far in whatever companies I've worked in 25 years, I have never come across FIFO or LiFO, only weighted average.
Exactly. That's the correct one. Sir.
Yeah. Okay. Anyway, but that doesn't mean companies are not following it. It's following. Like I told you, 30% of the US companies follow the LiFO. Okay. It's formed there. So that's the way. So this is the inventory part. Okay. This is the inventory part. Now let us come to fixed assets. That is the property, plant, and equipment. Okay, property, plant, and equipment. What are the differences? What are the differences? Some are minor, some are major. Okay. Okay. What he says is, I'll just make it a little bit big so that everybody can see. Okay, estimated useful life and depreciation method under US GAAP will be reviewed when the circumstances change. Okay, something has caused something change in life, or they're using it more, maybe they have to charge more depreciation, etc. You know, because of the circumstances changing, immediately they should take action on it. But in IFRS, estimation of life and depreciation is done or reviewed annually. Okay, this is not a major difference, is it not? You do it when the circumstances change or do it annually. I mean, it's not, I don't think it's such a big issue. Okay, now, no requirement of component depreciation. Now, this is somewhat important. I wouldn't say very, but still somewhat. And component depreciation is required in some cases. Now, what is this component depreciation? Suppose you have got an aircraft. Okay, you have got an aircraft. Pardon my drawing. I like to draw. Okay, so okay, you have got an aircraft here. US GAAP would depreciate the entire aircraft. Okay, IFRS would depreciate the seats. Okay, seats, the engine. I don't know where the engine is. I put it there. Okay, right. So they would do depreciation for all those cases, and then they would do it for the entire aircraft also. Okay, they will not double count it. Okay, see, they would have already calculated depreciation for the seats and the engine, is it not? So minus that, whatever is remaining, for that also they would calculate depreciation. But for US GAAP, there is no requirement for component depreciation. They can depreciate the entire aircraft. Okay, right. I would suggest that this is not very important. This is a little bit important, but this is very important. Okay, revaluation to fair value is not permitted under US GAAP. Okay, but under IFRS, they are more lenient. Property, plant, and equipment can be revalued to fair value. Okay, so you can bump up your assets. In US GAAP, you cannot do it. Okay.
Hello?
Got it. That's why you have that revaluation reserve, is it not? Which goes to other comprehensive income. You remember? I told you about it. Okay. Revaluation reserve, they would create, which will go to the other comprehensive income. Another item for IFRS. Otherwise, US GAAP has 4 items. Okay.
Hello?
Yes.
Sir, the revaluation, though is allowed in India, it is considered as not very prudent practice.
Ah, okay, sir. You're a chartered accountant?
But I have been in the chartered accountant, I've done on UK fellowship.
Ah, okay. Yes. Yeah, you know, because everybody frowns upon bumping up your assets, you know, because you know, you're trying to inflate your income, or at least it's not going to the income statement, but at least you're increasing the value of the company, is it not? Yeah. So conservatism is the thing. Give the bad news, not the good news. That is the you know, principle of accounting. Okay, so that when the good news comes, nobody will scold you.
Yeah.
Okay, what you sir, you told you'll give me only 100, you're giving me 200, nobody will say. Okay.
But
if you tell them you're going to give them 100 and you give them 50, they are going to come after your neck.
Revaluation is not considered prudent.
Yeah, that's
practice.
correct. Okay, the other here thing is interest earned on construction funds are not allowed to get offset by interest cost. Now, these are all small differences. Okay, what I mean to say is you took a loan, maybe you took a loan for construction. Okay, if construction is not happening, you put it in the bank. Okay, $1,000 you took a loan and put it in the bank. Okay, for some time. It got you, let us say, 5% interest. Construction not started yet. But because it's a loan, you're going to pay, let us say 12% interest. Of course, it will be bigger, right? Deposit and lending rates. Okay. So this cost should not be offset with this income. Okay. You have to show the income separately, how much you're paying. You got, let us say $50 and you're paying $120. Okay. Like this. Okay. You should show it separately. Whereas in IFRS, you can merge it. You can merge this $120 with this $50 and show the net and show the net. Okay. 70 minus you can show like this. I mean, these are all not very, very big differences, is it not? But I think this method is better. The US GAAP is better because you're showing exactly how much you earned and how much you're spending. Okay. So it's more informative to the stakeholders. This is one netted figure, but I wouldn't make so much of a fuss on it. What I would say the most important difference is not even this. I would say this is it. Right? Got it. Okay, so let us put it to practice and see how you would apply this concept. Okay, you should apply this concept maybe here. Take your time. You get an idea of how this is applied. Okay, otherwise, just telling you the theory, I can tell you for hours how to drive a car. Unless you sit and drive it, you will not know, is it not? Apply that concept of component depreciation. I'm going to give you only a little time, okay? Not too much. 3 minutes. Your time starts now. No, it's not correct, Atul. Try again. Praveen, no, you missed it. No, no. Try. Straight line method is followed. They mentioned there. Okay, since we are short of time, I cannot give you. So let us see what it is. Okay. No, still no. No. Okay. So, okay. Now, first of all, what are they going to depreciate? 10 years engine. Am I right? How much is the Indian engine cost? 25,000. Divided by 10 years. So it is 2,500. Okay. Then the seats, they're going to depreciate. How much does the seats cost, guys? How much is the seats costing?
10,000.
10,000.
10,000. Divided by how much?
10 years.
No.
8, sir.
8 years. 8
8
years.
years.
Mention that.
8 years.
Mention that.
8 years.
Yes, correct. 1 minute. Yes, it's here. The thing is, they put something in numbers, something in words, okay? 8 years. So that is equal to
1250.
1250. Okay, now listen carefully. The bus is 100,000. Okay, minus from it, because you're giving component depreciation, minus from it 25,000. Otherwise, we'll get double counted, is it not? And minus from it 10,000. What remains? 65,000 remains, is it not?
65,000. 65,000
Yeah, 65,000.
for 20 years.
Yes. 55,000 for 20, 65,000 for 20 years. How much is that going to be?
3250.
3,250. And what's the total?
$7,000.
Yes, that is how you have to apply this concept. You understand? So 7,000 is the right answer. This is a CPA question, you see, released in 2016. Okay, it is actual CPA question. Fine. So the solution also, I have taken it down here. Okay, I'll remove the writing there. So you should also, you should remove all that so that, it's not double counted. The component depreciation and then the final. See, that is how you apply this. In US GAAP, they say that this is not necessary. Okay. Right. You say no requirement for doing it, but companies can do it. Only thing, it's not required to do it. Okay. Right. So the main thing here is the revaluation part. Okay. Revaluation part. For that, I have got one more question, which is quite interesting actually. 1 minute. Let us see. Okay. I think it's this. Yes, this one. For you to get an idea of the revaluation under IFRS, right? Yes. Please do this. You will get an application of this. Or let us not do this. 1 minute. Sorry about it. Same question actually.
Hello?
Same question. You have to do this one. It is with choices, so it is easier for you to do it. Okay.
Hello?
Yes, tell me.
Sir, in the just example you just mentioned,
Ah,
if the seats are to be replaced every 8 years,
yeah.
that means in a lifespan of 20 years for the bus,
Yeah.
you have to replace 3 times.
Yeah.
So
Yeah.
after
Not
60
exactly
years,
3 times.
exactly. What I'm saying is,
Correct.
no,
I understood. Yeah.
third time you must do it.
Yeah.
So there will be 4 years life left for the seats.
Yes. 4
4 years.
years life. But what to do? The bus has gone.
No, but the value of they say the value of that 4 years is equal to 10% or more. It's significant.
Correct. Yeah,
That's what
that is. Yeah, but it was no.
I know. But
It was. Yeah, we should test that also. That since you brought up that point,
Yeah.
you see. Sorry, guys, I'm just interrupting. But the one important thing was they have told here that the components, which is 10% of the overall cost, is considered to be significant.
Yeah.
So 25,000 is more than 10%. 10,000 also is more than, equal or greater
Yeah.
than 10% they mentioned here. Okay. So yes, so you don't have to do every component. It should be material. Okay. So company has a policy. This is not given by IFRS or anything. It's a policy of the company. Okay. To what to consider significant.
So even if it is equal to 10%, even if it's significant, we can't do anything about it.
Yes. We have to, yeah. Right. Please do this one, not 2 seconds, this one, to get the idea of how you revalue it. Okay. Right. Now go ahead and please do this. Okay, Praveen says 1. This is also a CPA question. Okay. It's a CPA question, US CPA. But here they're following IFRS. Okay. So far, whatever answer is wrong. See, first of all, let me just explain. It was 100,000. Yes, D is the right answer. It was 100,000. It has gone down to 90,000. And now it is now 105,000. See, if it was inventory, you can update it only to 10,000. Okay, up to the original cost. But since it is PP&E, revaluation is permitted. So don't forget that. You can revaluate back to 100 and by 15,000 to 105. Okay, so what is this? This difference is how much? 15,000, is it not? So what will you do is debit land, increase its value 15,000, credit gain in the income statement, because the original write down when you made this entry, it had gone to the income statement. Okay, so you would credit gain by how much? 10,000, because you had initially written it down. When you written it down, you had put it to income statement, is it not? Put it back there and credit other comprehensive income, a revaluation reserve. That's what they would call it. Okay, 5,000. So this would be the actual entry. D is the right answer. So that's the application of this principle. You understand? Under IFRS. US GAAP,
Sir, Rishi here.
yeah. Tell me.
Yes, sir, but under IFRS, OCI will not be there, na? So
Who told you OCI? I just did it. You were there, Rishi Raj, from the beginning?
no, actually, sorry, I was in between.
Okay. Just see
Fine.
the recording.
Okay, fine, not a problem. It's my wrong, sorry. Okay.
Yeah. In IFRS, that is the difference.
Okay.
Revaluation reserve will come. An
Yes, it is
extra
there,
item
but the
will come
revaluation is
under
not there.
other comprehensive income. Okay.
No, like I saying crediting OCI, instead of that, it will be a different account, what I was.
No. That is coming under OCI. They call it a reserve. That's all.
Reserve, yeah, that is why I wanted to confirm.
Okay.
Okay, fine, got it. Sir.
Right. Got it. So yes. So that is it. Because IFRS is very fond of the words reserve. You understood? And US GAAP hates it for some reason. Okay. Right. So this is how they would do. If it was US GAAP, what would have happened? If it was US GAAP, what would have happened? What would be your entry? Instead of IFRS, if this was US GAAP, you had written down your land to 90,000. Now it has become 105,000. What would you do? Do nothing. Let it be like that, even if it becomes 200,000. Okay. Right.
It's not permitted.
Not permitted. Revaluation not permitted. You got it? So those are the major differences between US GAAP and IFRS, where fixed assets are concerned, PP and E. Okay. Right. Now we'll talk about impairment. Now impairment, okay, we have time for that. Yes, impairment and IFRS. Okay, now what's the meaning of impairment? Can anybody tell me?
Wear and tear, sir.
No, wear and tear is basically depreciation. You see, you and me are getting old. Okay,
Yes,
we are getting
Yeah,
depreciated.
impairment.
It's not
Sir,
it is
can I-
not
can
cannot
I-
be used, sir.
Wait.
Impairment, it is still it is not, it cannot be used.
Not that it cannot be used, it's gone down in value.
Impairment is losing value.
Correct. You see, it's like, I'll give you an example. Now
Losing
you and
value.
me are getting old. Okay, every day we are depreciating. Wear and tear, or whatever you might call it. Okay, we are depreciating. That is looked after as depreciation. God forbid we meet with an accident, break a hand or leg or something like that. Okay, then we are impaired. That's why you say,
Capable of not working.
pardon?
Capable of not working.
Correct. For example, they call the hearing impaired, is it not? If you cannot hear properly, it is called hearing impaired, like that. Okay. So a sudden decline in value, like Shahjahan has told here, decline in value of the asset, other than wear and tear. Maybe it's, replaced by another technology, more modern technology. Okay. So then there is an impairment. Okay. So how do you carry out that impairment under US GAAP and IFRS? Okay. There is some things here. Just look at it. That's all. Okay. Is there an example? Just a minute. No, example I have not taken it, but we can see an example. Okay. This is for impairment. Read it once, I'll explain it to you. Okay. So you read it, some of it you have understood, some of it you have not had any idea what it is about. Okay, one thing I'll bring your attention to, one important thing, reversals as usual not permitted. Okay, if the asset goes up in value, not permitted. But you saw in the previous question what we did, reversals is permitted, except goodwill. Now US GAAP as well as IFRS would not reverse impairment of goodwill. Okay, would not reverse impairment of goodwill. There's a good reason for that. We'll come to that later. Okay, there is time, that is. Okay, so now that this is the most important thing you should remember. Now US GAAP has got a two-step process for impairment, and IFRS has got one-step process for impairment. Okay, now I will just explain to you.
Impairment losses.
Yes. Right, and they are going to use undiscounted cash flow, and how they are going to do this, that's what they're showing. Okay, and here how they are going to do it. Okay, so here what they do is they'll take present value for this. Okay, I'll come to that. Leave it. Okay, so I will show it to you how it's done. Go to the whiteboard. Okay, I'll remove this. Okay, so now US GAAP. US GAAP first. Okay, now let us say your asset original cost is 100. Okay, and you have got accumulated depreciation, let us say 80. Carrying amount is 20, or book value as they call it. Okay, now I'm going to put a lot of short forms, so please concentrate. The first step is to test for impairment, whether this asset is impaired or not. Okay, undiscounted cash flow. Undiscounted cash flow. What cash flow you can get from this asset, you're checking. Okay, suppose you can get $30 from this asset. Okay, suppose you can get $30 from this asset. It is not impaired. Okay, you are carrying it at a lesser value. You are not carrying it at a higher value than the cash you can get. So it's not impaired. You will not do anything. No action to be taken at all. Okay, this is the impairment test in US GAAP. Okay, now another situation. Suppose it is, you have estimated the undiscounted cash flow. Undiscounted cash flow you have tested. Okay, and it is $10. Now impairment has taken place because you can get from this asset future cash flows is $10, but you're carrying it at a higher value. You're overestimating the value of your asset. Okay, so what do you do? Now impairment has taken place. Now you'll compare it with the fair value. Now you'll compare it with the fair value. So any write down has to be done with respect to the fair value. Okay, it has to be done with respect to the fair value. So if the fair value is, let us say 15, the impairment, see, the undiscounted cash flow is only for testing for impairment. Okay, If it is impaired, you go to the second step. That's why they call it a two-step process. Okay. Now the impairment which has taken place is not 10, but 5. Okay, 5, the impairment. So what is the entry? The entry will be debit impairment loss. Debit impairment loss, which is $5. Okay. And where's the credit going to go?
Credit has to go to the asset account.
Asset.
No,
Asset, sir.
generally they will not touch the asset account because they want to keep the original cost as it is. So that is the surprise here. Okay. Credit accumulated
Then-
depreciation.
Accumulated.
Accumulated depreciation.
Hmm.
See, now what will happen? Automatically, the asset price would remain the same. They want to remain this, keep it the same. They want, because auditors will come and check that, okay, no? And accumulated depreciation would now become how much? 85, is it not? You gave it an extra credit, right? So now your carrying value is 15, which is equal to the fair value. Okay, which is equal to the fair value. This is how you would do impairment under US GAAP. Okay, now under IFRS, I think this recording is available. You can, because you cannot remember all this. Okay, so if you want to have a revision, I think you can request for a recording. I'm not sure if it's being recorded. I think so, yes. Okay.
It is recorded, sir.
Oh, yeah, it is recorded. Okay, now let me just tell you about IFRS. Okay, if I show it here itself is better. Okay, so now IFRS. Okay, so now what is IFRS? How is it done? Let us take the same asset. Asset 100. Accumulated depreciation 80. Carrying value 20. Now value in use. This is the one-step process. Okay, you're not going to do anything else. Here, one-step process. Value in use and fair value. Again, another difference. Less cost to sell. Sort of like a net realizable value. Okay. Okay. Now in US GAAP, it was only fair value. Here it is fair value, less cost to sell. And value in use is the present value of the future cash flows. Here it was undiscounted cash flows. Undiscounted cash flows. Here it is the present value of cash flows. Okay. Now if the present value of the cash flows is 18 and the fair value less cost to sell is 15. Okay. You would write it down to the higher of the value in use or the fair value, less cost to sell, higher amount. Okay, so you will not write it down to 15, you'll write it down to 18. Okay, and your entry is going to be debit impairment loss 18 and credit accumulated, credit impairment loss 2.
2, actually.
Yeah, 2. And credit accumulated depreciation 2. It would automatically adjust itself to 18, is it not? Now, again, now let me tell you something. Suppose, wait, I'm going to give you a question now. Suppose value in use, that's a present value of all cash flows, was 12. Yes, it will come directly to the P&L. No OCI business. Okay, it will come directly to the income statement. Okay, this was 12 and this was 15. What will be your impairment loss? What will be your impairment loss?
$5, sir.
$5. Yes, not $8. Okay, not $8. Higher of the two.
Okay.
Higher of the two. This is IFRS. Okay, But since IFRS is taking the present value, it is more likely that you might impair more assets under IFRS than US GAAP. So here IFRS is being more conservative actually. All this while US GAAP was conservative, because US GAAP now for the testing of impairment, they take the undiscounted cash values, cash flows. Okay, but here this is a one-step process. And let me tell you one thing, in US GAAP, this undiscounted cash flow comparison is only to test for impairment. The real impairment you will do with respect to fair value. Okay, right. So now with that, now you can understand what is mentioned here.
Hello?
One second. I'm coming to you. Yes. Yeah, tell me.
Yeah, sir, in these Indian companies,
Ah.
I don't find any balance sheets where the impairment value is calculated, the asset value is brought down to that level.
Correct. You know what? Actually, lot of scandal will be happening there. Okay.
Ah.
See, nobody is going to be so honest as to put down, because the share value all will come down. Okay. In fact, there was a movie created on this, okay, about companies or telecom company who did not revalue, did not test their equipment for impairment.
No, if there is a breakdown of machinery, maybe there is a case for it.
And auditors also find it very difficult to check this because they have to be from technical background,
Exactly.
Right?
No,
How will they come?
I don't know if
see, KPMG and all have got people of engineering background, everything. Okay.
But still, I don't find any Indian company doing it.
I have never come across in my life.
Exactly. I also see as the stock market is the same.
Because nobody wants to bring down the asset value and show it in the income statement. Share price, everything will get affected, is it not? But strictly they have to do it, I'm sure.
But is it mandatory under GAAP, sir?
It is mandatory, sir. It is very much mandatory.
Here it's not.
No. Even in IFRS, they are supposed to do it. They are not doing it. That's all. Okay. What they are saying is no asset is impaired. Finished.
Yes, sir. In real scenario, what they'll do is, at the most, they'll dispose of the asset. That's all. They'll show it as say disposed.
Okay. Disposal, if they show it will reflect
that. Instead of telling it is impairment or something, because it as you said, it needs a technical valuation. Correct.
Technical valuation should be done.
Yes.
It's easier for them to just sell it off and reflect. It will reflect the loss. Yeah. If it is really impaired, it will reflect the loss.
No, sir. In India, all the textile mills, their looms are all in 18th century looms. So they are impairment.
No, but I'll tell you one thing: they would be fully depreciated, so there's no question of impairment. Okay.
That we are using so many computers, laptops, printers, and almost all the companies. The age of the computers or age of the printers may be more than 5 to 10 years also.
Correct.
But do we make such all those printers as impaired or?
No. I'll tell you one thing, madam. It would have been fully depreciated, so there's no question of impairment. Okay.
Yes.
See, once it's fully depreciated, as it is, the value is 0. How can you make it -1? No, you cannot, right? So keep it there like that. Okay. We are talking about assets which are not depreciated fully, and there's a change in technology. They have to, actually reflect it. And lot of, many
software.
They will not do that.
Intangible assets, softwares are there. Those also have
correct. So intangibles also. Intangibles also. It will come under intangibles, and that also has to be impaired. Test for impairment. Okay. So now, if you look at this, now you'll understand clearly. 2-step process, 1-step process. Undiscounted cash flow. Fair value higher of, fair value less cost to sell, and value in use, which is present value. I showed it to you, right? No discounting, no reversals, except goodwill. Why except goodwill? You see, goodwill, self-generated goodwill is not allowed under US GAAP or IFRS. Okay, what do you mean by self-generated goodwill? It is sort of boasting, is it not? That we are good. Okay. For example, the balance sheet is like this. Okay. You have got capital 100 and assets 100. Suddenly you feel that you have gained reputation in the market, and your name is high. So you would enhance your balance sheet by putting goodwill like 50. Put one capital reserve here, something like that. That's credit 50. So you increase the value of the company now to 150, which is wrong. You cannot do this under US GAAP or IFRS. That is called self-generated goodwill. Okay, you do some calculation and put a goodwill entry there. For partnership concerns, it's allowed, but not for companies. Okay. So
One
only
question,
if you purchase a goodwill, you can put it on the balance sheet. That means you purchased a restaurant, let us say, okay. Its net assets, that is assets minus its liabilities, is 100. But you paid 1,000 for it. It happens. Okay, it happens because this restaurant is a very famous restaurant, let us say. So what has happened? You have paid 900 more than the fair value of the net assets. Okay, more than the fair value, you have paid 900 more, and that is goodwill. That can be brought onto the balance sheet, and that should be tested for impairment. That comes later. Okay, right. And once it's impaired, you cannot reverse it under IFRS or US GAAP. You cannot reverse goodwill. All other assets you can, because if you reverse goodwill, it is like self-generated goodwill, is it not? Because once you impaired it and now the name has increased, the name and reputation of the firm has increased because of the current company, the current owners' good deeds, is it not? Right? They enhance the value of the company. So if they reverse the goodwill, it's like putting self-generated goodwill. You understand? So they don't record reversal of goodwill, both IFRS and US GAAP. Okay. Okay, guys, I would have given you an example of how to apply this concept. Okay, right. But I think we gave you the reversal, right? We already did, yeah, the land one we have done of how to reverse the value. Okay, reversal of impairment. We did that land question, right? From 90 to 105. Okay, so you got an idea. Okay, so we could have done more, but now time is over. So with this, we would end the class. Okay, so these are some of the major differences. See, mainly we did fixed assets and inventory. Okay, we could have done intangibles and goodwill if there was time. Okay, but mainly these are the main things we have done it. This is the area where it is most different. Okay, right. Other areas also are there, definitely. But if time permits, we could have done it. Okay, so for the moment, I am going to end the class. And if you have any questions, I'm going to give you some time. We'll discuss it. Any questions?
Sir, I have one question.
Yes.
In case of, you told the example of goodwill, say suppose that $900 the company is paying extra to the old owners.
Correct.
But say suppose if it is an ongoing concern and only the shareholding changes, like from shareholder A to shareholder B.
Yes.
And the shareholder A was maintaining the same balance sheet, or they had some members' current account with them, you know, where the members had contributed the amount.
See, but the shareholders of A is taking over, right? The company A is taking over company B, right?
Yes. So say suppose shareholder B is taking over the company of shareholder A, and they are paying some money extra on the top, but from their own contribution and not from the company's reserves. In that case, it can be treated as members' current account as per IFRS, or goodwill is required.
Goodwill is required to be shown. Okay.
Required to be shown.
Yes, it is required to be shown. Okay. If it is coming from the company's books, definitely goodwill requires to be shown. If it is going individually between individual shareholders dealings, then they will, record the gain in their books. Okay. But otherwise, your goodwill has to be shown. Anything more than the fair value of the assets. Okay.
Right. And it will be estimated, no, some time period for what do you call impairment of goodwill, or
impairment of goodwill should be tested annually as per IFRS. Okay. When circumstances change under US GAAP.
Okay.
Okay. There is ways of testing impairment of goodwill, but we didn't have time to do it. Okay.
Right. Right. Thank you.
Right. So anything else?
sir, will there be any other class session like this for other IFRS like a lease,
You like the class, is it?
lease? Yes, sir. Lease payments, borrowed capital, some important
Yes,
issues.
actually, you know, contingencies. There are a lot of
Yes,
differences there.
yes, 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 sir.
Okay,
Yes,
right.
sir.
Leases, not too much, only the wordings. Okay, US GAAP is more rule-based. IFRS, because it's a global standard, right? I mean, everybody is following it. They are not so much, they don't keep tight rules. Okay, US GAAP, since it's pertaining to certain country, they can put those tight rules as they like. Okay, so leases also there is some interesting differences.
Yes, sir.
Contingencies there is, investment area there is.
Yes.
Okay, yeah, we can request Baswati if you know, if she has, because I'm just guest faculty here. They have
Okay.
to organize. If they organize, I will definitely most gladly do it again.
Yeah, if it is on Sunday or something, even if it is for 3 hours, it will be very useful, sir. Next time we'll plan like this.
Okay, right.
A small request, that's all.
Okay, you can request the owners.
Okay.
Right. So yeah, they have to organize. I'll be glad to take it. Okay, and this is a very nice group. I enjoy doing it. Okay, good night, everyone.
Good night, sir. Thank you, sir.
Yeah.
Thank you.
Good night, sir. Good night, sir.
Good
Thank you
night.
very much.
Good night.
Good night. Bye-bye.
Right, sir.
Good night, sir.